Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting on the 4-hour time frame with the bullish scenario where we're looking for an impulsive structure to the upside, where the common target for 5 is between 73.3k and 75.8k, and the invalidation is sitting at 65.5k as a wave 1 and a wave 4 in an impulse are not allowed to overlap. If the low of wave 4 is in and we are looking for impulsive continuation to the upside, then on the 1-hour time frame we have to count a double 1-2, and that is mainly because of the volume over here. In an impulsive structure, the highest amount of volume is by far most commonly inside a wave 3, so preferably we then count this latest move towards the upside a wave 3. That therefore means that the previous ranges are going to be labeled as wave 2s. So in this scenario, what we are looking for is a wave 1-2 in blue, looking for a 3, 4 and a 5. And inside the blue wave 3, we have the wide count 1, 2, 3, 4, 5. In this scenario, if the high of your wave 3 is in, we're looking for a wave 4 to the downside. The common target for your wave 4 is between the 0.236 and the 0.382 Fibonacci, taken from the low to the high of your wave 3. This gives you a target between 70.7k and 70.3k. The invalidation, however, for this impulsive structure to the upside is again the high of wave 1 here at 70.3k, because a wave 1 and a wave 4 are not allowed to overlap in an impulse. If price moves to the downside and touches 70.3k, the only bullish alternative would be a triple 1-2, 1-2 in blue, 1-2, 1-2, and then continuation to the upside. However, the probabilities for this are not that great, and also if we do look for a triple 1-2, then we want to see a corrective structure to the downside here and not an impulsive structure. The invalidation for a triple 1-2 is the low over here at 68.5k. Alternatively, your second bullish scenario is a WXY, where this low here is not the low and the end of wave 4. We expect a continuation of this range and only move to the upside at a later stage. Here we have a zigzag in wave W, a complex WXY inside the yellow X, and look for a wave Y towards the downside. In a sideways double combo WXY, if wave W is a zigzag, wave Y cannot be a zigzag. So we either have to look for a triangle structure here, which means that we want to start looking for zigzags on the lower time frames, or a flat structure in a wave A, B and a wave C. Now in this scenario, the common target area for your blue wave Y is the 1 to the 1.236 trend-based fib extension, taken from the low to the high of W to the end of wave X, which is where we are at the moment, and the 1.618 is a rare target for wave Y, sitting at 72.6k. On the daily time frame, the bearish scenario is a zigzag, a 5-wave leading diagonal in A, a 3-wave B, and looking for a 5-wave C to the downside. The most common target for a wave C is between the 1 and the 1.236 trend-based fib extension, taken from the high to the low of A to the high of B, giving you a target between 54.6k and 50.5k, with the extension target, the 1.618, at 43.9k. That means that on the lower time frames we want to count impulsive structures to the downside. So the first move down from 72k here has to be counted as an impulsive structure. That means that if this is your wave 1, we need to count this as a wave 1, 2, 3, 4, 5, where wave 5 is your extended wave structure instead of wave 3, which is quite rare, as by far most commonly a wave 3, 1, 2, 3, 4, 5 is your extended wave. Nonetheless, we then count this as a wave 1, a 3-wave correction in 2, and we want to count a very big wave 3 towards the downside. A rare target for a wave 2 is the 886, however. That means that any move towards the downside now has a higher probability of being a wave C or a wave Y, which in turn increases probabilities to sooner or later take out this high. It significantly lowers the probabilities that this high here is the high of a wave 2 and any move to the downside is a wave 3, lowering the probabilities for the daily bearish scenario that I have just shown. The invalidation is taking out the high here at 71.9k, pretty much 72k. Now the 886 is, however, a common target for a wave B. So alternatively, your bearish scenario here is a wave A, a 3-wave B, and a 5-wave C to the downside. The most common target for your wave C is between the 1 and the 1.236, 65.6K, 64.3K, taken from the start to the end of A to the end of wave B, and the extension target for wave C, the 1.618, sits at 62.1K. This scenario, this zigzag to the downside in an A, B, and then a wave C to the downside on the daily time frame, is then part of a sideways WXY. Here we have a regular flat in wave W, an expanding flat in X, and look for a zigzag to the downside in a wave Y. The common target for your wave Y is between 63.1K and 54.3K. The 0.618 to the 1.236, taken from the start to the end of W to the end of wave X. Looking at the CVD divergences, the bullish CVD divergences we had here played out as price took out this high, and also the bullish CVD divergences that price has been forming as price moved towards the upside have played out because we constantly took all the highs. As price is now ranging locally, we continue to observe new potential CVD divergences. We also have some news today at 4 p.m. Central European time, so make sure you trade safe around these hours. And if you then finally look at the probabilities of the different scenarios, then on the 4-hour time frame, the probabilities are higher for the bullish scenarios compared to the bearish scenarios. The WXY would have a slightly higher probability than the impulse due to it being lower probabilities of this being the end of this range over here at 66.6K, but of course that means we first want to see local proof of weakness and proof of resistance for price to turn around and continue this range sideways. The bearish impulse over here is a lower probability scenario because price hit the 886. Generally, based on the above, a continuation of the range would have some higher probabilities, and in that case, I keep an eye out for potential proof of weakness. As long as we don't see some proof of resistance, proof of weakness, we're not going to be looking for a continuation of the range. Based on a retracement to the downside, we can reanalyze the probabilities as well. If we get a corrective move to the downside eventually, then we're going to be looking for price to continue towards the upside sooner or later. If, however, we get a retracement and it's going to be an impulsive move to the downside, we look for more bearish structures to take the lows of this range. The probabilities will change if price hits 70.3K, as that invalidates the impulse 1212, 34545, and therefore the probabilities will be higher to continue this range. If price moves to the downside, touching 68.5K, it also invalidates a 1112, 12, 12, 12 continuation to the upside, which increases probabilities for the bearish scenarios as well as the sideways WXY, a continuation of the range. If price takes out 72K, it will increase the probabilities for bullish scenarios. I hope that this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.